If you've ever worried that earning more money will actually leave you with less money, you're not alone. A lot of Canadians misunderstand how tax brackets work, and that confusion can lead to bad financial decisions, especially around overtime, raises, and RRSP contributions. Today, I'm going to break down Canadian tax brackets in plain language, explain how marginal tax rates actually work, clear up the biggest myth around earning more, and show you why this matters when deciding whether to contribute to an RRSP. One of the most common fears people have is that earning more money will actually hurt them. You might hear people say that if they work overtime or get a raise, they'll move into a higher tax bracket and end up taking home less money. This idea comes up all the time, and it's one of the biggest misunderstandings about how the Canadian tax system works. Canada uses what's called a progressive tax system. That means you don't pay the same tax rate on all of your income. Instead, your income is divided into layers, called tax brackets, and each layer is taxed at a different rate. As your income increases, only the portion that falls into a higher bracket is taxed at the higher rate. For 2025, the federal tax brackets look like this. Income up to about $55,000 is taxed at 15%. The next portion up to about $111,000 is taxed at 20.5%. The next portion up to about $173,000 is taxed at 26%. Higher income levels are taxed at 29% and 33%. These are federal taxes only. Provincial taxes are added on top, but the system works the same way. Here's the key idea most people miss. Only the income inside each tax bracket is taxed at that bracket's rate. This is where the concept of marginal tax rates comes in. Your marginal tax rate is the rate applied to the last dollars you earn, not your entire income. Let's walk through a simple example. Say you earn $70,000 in a year. The first roughly $55,000 is taxed at 15%. Only the remaining roughly $15,000 is taxed at 20.5%. You do not pay 20.5% on your entire $70,000. Because of this, your average tax rate is much lower than your marginal tax rate. So let's tackle the biggest myth head on. If you move into a higher tax bracket, only the dollars above that threshold are taxed at the higher rate. Your previous income is still taxed exactly the same as before. The only time it might feel like you're taking home less money is because of things like payroll deductions, the loss of income-tested benefits, or incorrect tax withholding, but earning more money on its own never reduces your after-tax income. This is where understanding tax brackets becomes really powerful. RRSP contributions reduce your taxable income. That means they reduce the income that's taxed at your highest marginal tax rate. The higher your tax bracket, the more valuable that RRSP deduction becomes. For example, if you're in a 30% combined tax bracket, every $1,000 you put into your RRSP could save you about $300 in tax. If you're in a 40% tax bracket, that same $1,000 contribution could save you $400. That's why RRSPs are especially valuable for higher income earners. On the other hand, if you're in a lower tax bracket, the RRSP deduction isn't as powerful yet. In those cases, a TFSA often makes more sense early on, and you can save your RRSP room for later when your income is higher. So here's the takeaway. Tax brackets don't punish you for earning more money. Canada's marginal tax system means you always keep more money when your income increases. And once you understand how tax brackets work, you can use tools like RRSPs much more strategically, keeping more of your hard-earned money instead of sending it to taxes. If you found this helpful, make sure to check out my videos on RRSPs and TFSAs to see how tax brackets tie directly into smart saving strategies. Thanks for watching. This content is for educational purposes only and is not financial advice. It does not take into account your personal situation or goals. Consider speaking with a qualified financial advisor before making financial decisions.